What if the ETF you've been told is safe is actually holding you back from financial freedom? When I first started dividend investing, SCHD felt like a no-brainer. And everyone in the community talked about it like it was the gold standard. Low fees, reliable income, blue chip companies. What's not to love, right? But here's the problem no one tells you. Sometimes the most popular choice isn't the most profitable one. And over the last 5 years, while SCHD was doing its dependable thing, another dividend ETF was quietly pulling way ahead, not by a little, but by tens of thousands of dollars on the exact same starting investment. That's the kind of gap that can decide whether you hit your financial goals early or spend extra years grinding it out. And the craziest part? This isn't some exotic high-risk gamble. It's a mainstream fund hiding in plain sight, built on a completely different philosophy from SCHD, one that rewards a very specific type of investor. Today, I'm going to show you exactly how these two ETFs play the game, why one has been winning recently, and more importantly, when that advantage could flip overnight. And yes, I'll put them head-to-head with real money simulations so you can see the exact dollar difference for yourself. If you've ever wondered whether you're in the right dividend ETF, or if you've just been following the herd, this video could be the wake-up call that changes how you invest for the next decade. The SCHD story, America's dividend darling. SCHD isn't just an ETF, it's a comfort zone. It's the warm, reliable pickup truck that starts every morning, gets you where you need to go, and doesn't guzzle your savings in the process. For over a decade, it's built a loyal following by focusing on one thing: quality you can count on. Its rules are strict, brutally so. If a company hasn't paid a dividend for at least 10 consecutive years, it doesn't even make it through the door. And for the lucky few that do, they face a second round of tests: high return on equity, strong cash flow compared to debt, a healthy dividend yield, and a solid 5-year dividend growth rate. That's how SCHD ends up holding household names like Coca-Cola, Chevron, and Verizon. Companies that don't just survive recessions, they often come out stronger. It's the ETF equivalent of a don't rock the boat strategy, which is exactly why retirees and conservative investors love it. But there's a catch. That same discipline that keeps SCHD stable also means it ignores up-and-coming dividend payers that haven't built a long track record yet. And in certain market cycles, that can cost you growth. Meet FDV, the new challenger. If SCHD is the veteran quarterback, FDV is the rookie with raw talent and no fear of taking big shots downfield. This ETF doesn't care about a 10-year dividend history. It's all about who's paying now and who looks like they'll keep paying and growing those dividends in the future. FDV leans heavily on Fidelity's own research to find companies with a high yield today and strong future potential. That opens the door to newer dividend payers, especially in technology, that SCHD wouldn't touch for years. It also means FDV can invest in REITs for real estate income, and even sprinkle in international stocks for diversification. This flexibility makes FDV feel more like a growth and income hybrid than a pure defensive dividend play. It's designed for investors who are willing to accept more short-term volatility in exchange for the chance at bigger long-term gains. But here's the trade-off. What gives FDV its firepower is also what makes it less predictable. When those aggressive bets pay off, it can soar past SCHD. When they don't, the fall can be sharper. Sector Showdown, where your money really goes. Here's where the philosophies of these two funds really show their colors. FDV is all in on the future, with roughly a quarter of its portfolio in tech. Think Microsoft, Nvidia, Apple, Broadcom. Companies that are not only leaders today, but are shaping entire industries for the next decade. This concentration in high-growth sectors has been the rocket fuel behind its recent outperformance. SCHD, it's the definition of defensive positioning. Tech makes up less than 9% of its holdings. Instead, it piles into consumer staples like Coca-Cola and PepsiCo, energy giants like Chevron, and healthcare leaders like Amgen. These are sectors that might not shoot the lights out in a bull market, but they tend to hold their ground when things get rough. FDV also stands apart with nearly 10% in real estate through REITs, a whole income stream SCHD deliberately excludes. And while SCHD is more concentrated, with over 40% of its value in its top 10 holdings, FDV spreads the love a bit more, reducing its reliance on just a handful of names. In short, FDV is betting big on where the puck is going. SCHD is betting big on the players who have already won championships. Performance breakdown. Who made more money? The last 5 years have been like a stress test obstacle course for investors. Pandemic crash, record-breaking recovery, inflation spikes, interest rate hikes. The kind of market chaos that separates the safe bets from the high flyers. In that chaos, FDV took the lead. Thanks largely to its tech-heavy approach, it posted a compound annual growth rate of 15.75% over the last 5 years. SCHD, a solid but lower 11.25%. That's not just a number on a chart. Over 5 years, that gap can mean tens of thousands more in your account. But here's the reality check most people miss. Performance is path-dependent. FDV's recent lead has a lot to do with the surge in tech stocks during 2020, 2021, and again in 2023 to 2024. Zoom out further and the story changes. Since their respective inceptions, SCHD and FDV have delivered almost identical annual returns, about 12.3% per year. What's different is consistency. SCHD has been holding that pace over a much longer and more varied market cycle. FDV's numbers look great now, but its history is shorter, and its performance is more tied to certain sectors winning big. So yes, FDV has made more money recently. But the bigger question is, will you still be smiling if the next 5 years don't look like the last 5? Risk and resilience, the drawdown test. Making money is exciting. Keeping it is what keeps you in the game. When the market panicked in early 2020, FDV's aggressive bets on tech and growth-oriented stocks came with a price. It fell 38.35% from peak to trough. SCHD, holding steadier sectors and battle-tested companies, fell less, 33.37%. Still painful, but less severe. Fast forward to 2022, a completely different crisis. Inflation was surging, interest rates were climbing fast, and growth stocks were taking a beating. FDV dropped 20.18%. SCHD, only 8.89%. That's not just resilience on paper. That's the difference between staying invested and panic selling at the bottom. Here's the key takeaway. FDV has the firepower to win big in growth-fueled markets, but it also takes bigger hits when things go south. SCHD is the steadier hand. It may not always win the sprint, but in the marathon, it protects your capital when it matters most. $100,000 simulation and DCA reality check. Percentages are nice, but they don't hit you in the gut the way real dollars do. So, let's put these ETFs to the test in 2 real-world scenarios. First, the $100,000 lump sum. 5 years ago, if you had dropped that into FDV and reinvested your dividends, today you'd be sitting on about $207,781. The same $100,000 in SCHD, roughly $170,412. That's a $37,000 difference. The price of a new car, a year of college tuition, or shaving years off your mortgage. But most people don't invest that way. So let's test a more common approach. Start with $10,000 and add $500 every single week for 5 years. That's $140,000 total invested. In FDV, you'd end up with about $212,102, a gain of over $72,000. SCHD would have you at around $188,586. Still a healthy profit, but $23,500 less than FDV. Those are the kinds of differences that compound over a lifetime. But, and this is the big but, they also come with the bigger drawdowns we saw earlier. Which brings us to the most important question, and which is right for you. This isn't about crowning a winner, it's about picking the right tool for the job. If you're in your 30s or 40s, have a long investing runway, and can stomach bigger swings in your portfolio, FDV could be your engine. It blends strong dividends with exposure to high-growth sectors like tech and real estate. When the market's running hot, FDV can supercharge your returns. But if you're closer to retirement, or you just sleep better knowing your portfolio is built on a foundation of proven, financially bulletproof companies, SCHD is your steady hand. It's the ETF you can hold through storms without second-guessing every headline. Think of it like this. FDV is the accelerator. SCHD is the seatbelt. In a perfect world, you might use both, but you need to know which one should be driving your portfolio. So what's your move? Are you Team FDV, chasing growth with a high dividend twist? Or Team SCHD, locking in stability and consistency? Drop your answer in the comments. I read every single one. If you got value from this breakdown, hit that subscribe button for more data-driven ETF comparisons, and dividend investing strategies here on Dividend Hustle. I'm Mark, and I'll see you in the next one, where we put two more heavy hitter ETFs head to head and uncover which one truly deserves your money.